Okay, hi everyone. This is going to be the first lecture for chapter 9, right? We're looking at business income, deductions, and accounting methods, right? So, really, what we're talking about here is a business, right? Their income, their deductions, right? So, this is in distinction to something you'd see on like an individual return. Maybe if they had a Schedule C, that would be okay. But remember, we're looking here generally from like a C Corp, an S Corp, a partnership, or an individual who is self employed, right? And self employed is different from being a W 2 wage earner, right? So self employed would be somebody who kind of runs their own show, has their own business, maybe like a barber, or they paint houses, or they do consulting, right? So we're looking in kind of these contexts, what type of income do they include in that business and what type of expenses are they allowed, right? So starting here with gross income, this is going to be a broad inclusive concept, namely all income from whatever source derived. And when you're talking about a business, right, this would be things like from your sales, the services you provide, rental income, if you're a landlord, right? So you just think, hey, this is like the income from the business, what you would foresee and be reasonable. And one thing we do have to be aware of here that's going to be kind of a running theme throughout this PowerPoint and several other PowerPoints is whether the business or the taxpayer is considered a large taxpayer or a small taxpayer. Why do we care about that? Well, if they're a large taxpayer, they're going to be subject to kind of enhanced rules, more kind of like headache, more complex rules, more accounting. If they're a small taxpayer, they'll have like kind of the general rules. So it's like small is easier, normal rules. Large taxpayer, you have enhanced rules for it. So how we kind of make that distinction, if you're subject to these enhanced rules, is this gross receipts test, right? And the gross receipts test says this. If your average annual gross receipts for the last 3 tax years does not exceed 29 million, then you're considered a small taxpayer, right? So 29 million is the threshold here. If we look at your last 3 returns, right, and your sales, right, it's like line 1. It's not your income, it's your gross receipts, your sales. Exceed 29 million, you're large. If it's less than 29 million or 29 million, it does not exceed, then you're small. So a little bit easier row to hoe if you're small. So here's some examples, right? So we got year 1, year 2, year 3, right? What you do here is kind of, add them together, divide by 3. Hey, there's 28 million. We're below it. We're a small taxpayer. If we change the facts, right, if in year 3 there was 34, you'd fail the test, right? It would be 29.3. Now we're a large taxpayer. There are special rules in play, right? If the business has been not in existence for 3 years, so they kind of annualize it or look it over a different period. If we look at 9.1 here, right, they're giving us some information. Here in the first one, right, there's 3 years of receipts. Right, so they're giving us 20 million, 25, and 30. Are they a small taxpayer? Well, yeah, when you add these 3 up and you divide by 3, their average is 25. That's less than 29. Okay, we're a small taxpayer. We don't have those rules. Some different variations down here. If the business has only been in play for 2 years, right? So you got to kind of average it there over the 2-year period. And then down here, if they've only been in business for 1 year, right? So this shows 3 years. Up here, this shows 2 years. And this is less than 1 year, how you would kind of approach that to determine and see what's going on. If you think about it, right, 29 million is a pretty big number. So what that means is this is only like really big guy businesses that are going to be subject to it. Your average kind of local or regional business, they may not have 29 million in sales each year on average over the last 3 years. Okay, so we talked about income. We said that it's going to be business gross income is all income. We said we got to be aware of like large and small taxpayers because they're going to come into play for specialized rules. Now let's talk a little bit about expenses. All right, so we're talking again about expenses for a business, right? So these would be business expenses. Most business tax returns, right, like the 1120 for the C, the 1120S for the S, the 1065 for the partnership, or the Schedule C for the sole proprietor, they're not set up like the basic 1040 in the sense that they give you like a standard deduction and itemized. No, you get business expenses basically for reasonable business expenses, things that are foreseeable that you would think and associate with running a business, right? And the standard and kind of the magic language they use is you get business deductions for ordinary and necessary business expenses. And this is for a trade or business, right? That's in distinction to a hobby, right? The code doesn't define what a trade or business is. That's kind of purposeful. They want to leave it ambiguous. But the idea with a hobby is, right, the difference between a trade or business and a hobby is there a profit motive, right? Are we selling like customized cornhole boards that's our main job, right? We're making tons of money from, or are we kind of gluing popsicle sticks together and maybe every once in a while we'll get a sale from it for $5 or something, right? The former is more of a trade or business, where the latter is a hobby. It's more like for personal enjoyment. Whenever you have a hobby, they're really going to limit and curtail your expenses. You generally will not get business expenses for that. So that's kind of a starting point. When we talk about ordinary and necessary, what do these terms mean? Well, we said a deduction, a business expense has to meet both, and an ordinary expense is one that's normal or appropriate, right? It's what you'd think of with the business, right? It doesn't have to be like repetitive or typical, like it incurs like every month on the month, right? So like if you had a one-time lawsuit against you, somebody slipped and fall on your premises and you sued the person, or the person sued you and you had to hire an attorney, well, that would be a business expense, right? It's like a one-time thing. Likewise, a necessary expense is an expense that's helpful or conducive to the business activity, but it doesn't have to be essential, right? It's not like we absolutely need this thing. So, hey, maybe we buy this tool that we're going to use in the business, and we think we're going to use it, but we're not 100% sure, right? It doesn't have to be like the end all be all, as long as it's reasonable, foreseeable, ordinary, and necessary. So, what are some things you would think about, right, for typical business expenses? Right, so these are these guys right here. So like advertising, car, truck expense, depreciation, salaries you pay your employees, insurance, interest expense, legal, rent, repairs, supplies, travel, utilities, wages, right? It's kind of a lot of that stuff you'd see on an income statement, right? So one thing with ordinary and necessary business expenses is they have to be reasonable in amount, non-extravagant, right? So you're generally, right, not going to get a deduction for driving a Porsche in the business. They're going to kind of cap that down. They're not going to let you get a meal where it's caviar, right? Now, there are situations, right, in specific context, very limited context where that may be allowed, but in general, they have to be reasonable, right? And how they determine if it's reasonable is they look to see, is this in an open market, an arm's length transaction, reflective of what it would cost. So if we look at 9.3, I'll just kind of summarize it. They kind of give an example there. Hey, imagine we have a construction company, right? We're going to shovel out a stadium, right? It's packed with snow. They hire us to come in and kind of clean out the snow, right? Say we have 4 employees, 3 of them are just average Joes off the street. One of them's our brother, right? We pay the employees $20 an hour, and then we pay our brother $35 an hour, right? The idea with that is you're not going to be able to do that and get an expense for 35, right? From the businesses, the construction company's point of view, that would not be reasonable in amount, right? There's nothing special about your brother. You can't pay him more and get a bigger deduction. We're going to kind of cap that down to 20. Now, like I said before, there are circumstances. If your brother was like Brock Lesnar or something, right? He was super strong and he could shovel that snow 2 times as fast as everybody else, then yeah, it would be reasonable in that situation. But if he's just an average Joe like the rest of the employees, sorry, we're going to cap you there at 20. Okay. Next, let's talk a little bit about sort of caveats or prohibitions, limitations on business expenses. So we said, yes, they have to be ordinary and necessary, reasonable, foreseeable. And the idea with it is just because you meet that definition doesn't mean you're automatically going to get it. In other words, we have a wide variety here of situations that you may think you receive a business expense for, but you don't, right? So we have expenditures against public policy, political contributions, capital expenditures, expenses associated with tax exempt income, personal expenditures, mixed motive items, M&E, travel, and property use. Okay, so let's kind of unpack this. First one here is expenditures against public policy. You do not get a business expense for fines, fees, penalties, bribes, kickbacks, right? The idea with this is, hey, your company is a steel company and you get fined for dumping toxic sludge into the river, right? We're not going to reward you. That would be bad policy to give you a tax deduction for that. So even though it's reasonable and foreseeable in some sense, we're not going to give it to you for it. Likewise, right? Maybe you're driving to a customer, right? You're a sole proprietor, you're an Uber driver, and you get a speeding ticket, right? You don't get to expense that speeding ticket, right? They're not going to reward you for breaking the law and give you a deduction, right? So that kind of shows it there. Do be aware your illegal income is also reportable income, right? So like I said, I saw a IRS notice one time. It was like, don't forget to report your stolen income. Is there sort of like the reality that nobody's going to do that? Yes, of course, but do be aware it's taxable. That's how they got, Al Capone, among other things, was tax evasion, not reporting his illegal income. All right, next one here is political contributions and lobbying cost. If you donate to the Trump campaign, right, you're not going to get a business expense for it. Think about it, right? They're not going to fund, it would be bad public policy to let big businesses get an expense for basically getting a certain political candidate into office, right? So donations to political candidates, you pay lobbyists to try to change the law. We're not going to reward you for that. That would be bad public policy. All right, next one here is capital expenditures. And really what this says is under tax law, if you have assets that are long-lived assets, you generally have to capitalize them, do not immediately expense them, and then, depending on the type of asset, depreciate it if it's a physical, tangible asset, or amortize it if it's an intangible asset. So this is basically, why is this here? Well, hey, you buy an asset, general rule is you do not expense it immediately. You have to capitalize it and then depreciate it over time. Now, there's a bunch of exceptions to this, right? There's a de minimis exception, which says like small guy stuff you can immediately expense. There's section 179 and bonus depreciation, right? Which basically de facto let you expense a lot of this stuff. So there is the general rule, but it's kind of like Swiss cheese, right? There's like more holes to it than there is actual cheese. All right. All right, next one here is expenses associated with the production of tax-exempt income. What does this mean? Right. Well, if you recall from your like sort of intro tax class, municipal bond interest income, right? So you invest in a bond, right, that's issued by a state or local government, right? Maybe West Virginia needs to build a bridge, so they sell bonds, right? So you give them some money, 10 grand, they give you some interest, they give you some interest, they give you some interest, then they give you your 10 grand back, right? That interest income there is muni bond interest income. And for federal income tax purposes, it's not taxable, right? So the idea with this is, let's say that the 10 grand, you go to a bank and you borrow it, and then you buy the muni bond with it, right? And then on that 10 grand, you pay $300 of interest expense, right? What the IRS says is, we're not going to give you the double dip. That is to say, we're not going to let you on that single 10 grand, one, take an expense for the interest, $300, and two, on the back end, not claim the income from the munis, right? So it's like dip one, expense up front, dip two, tax exempt on the back end. No, you only get one of those, right? So we're not going to allow the expense up front. Likewise here, life insurance premiums for like kind of key figures. What's going on here? Well, um, whenever you have premiums, right? So like any kind of insurance premium, it's like monthly. Like your car insurance premium versus your deductible, right? Your premium is what you pay every month. Your deductible is what you pay when you're in an accident in it. But in any event, what's going on here is if you have this life insurance policy on the CEO or something, right? And say this guy dies in a plane crash, whenever they pay out the insurance proceeds, it's not going to be taxable income, right? So again, they're not going to give you the double dip of one up front whenever you pay the monthly premium, get an expense, and then two, dip two on the back end when the guy dies, not have to pay tax on the income. So in these cases, these would be expenses up front that are disallowed, even though they're ordinary and necessary. We're not going to get you there and let you take it. Okay, next one, personal expenditures. These are generally not going to be deductible, right? So clothes you buy in your everyday life, your personal use vehicle, right? Your boyfriend, your girlfriend, right? Like you have an expensive boyfriend or girlfriend, you're taking them on a date, you don't get any deductions for that. It's only things that are related to a business, right? And yeah, sure, are there some exceptions, right? Maybe you're a doctor, right? You run your own business. Again, remember, we're talking about self-employed taxpayers. We're not talking about W-2 here. But say you have a self-employed doctor and he buys scrubs, right? Yeah, in that case, he could probably expense those because he's not wearing those scrubs in his everyday life. But if he were to just buy like a Patagonia jacket, right, probably not going to be able to expense that because it's compatible for everyday life. He can use it. Okay. And then do be aware education expenses. If you're running a business, right, say you're a sole proprietor, you can deduct the education expenses then, right? If they help you improve or maintain your skills for an existing trade or business, right? So say, for example, I'm doing consulting work or something, right? And I said I'm finishing up my MBA, right? And I'm doing kind of like specialized accounting, uh, consulting. I'm an SE taxpayer. Well, hey, in that case, because I have an existing underlying trade or business, I can expense my MBA tuition. But in distinction, for a lot of you guys, right, if you're taking like, this accounting class, you don't have an underlying trader business. It's not an existing trader business that's going to improve your skills or maintain your skills because you don't have the skills yet, right? So taking this class, you're not going to get a business expense for it. You might get a tax credit, right? But you're not going to be able to generally expense that. Okay, next thing here, mixed mode of expenses. So these are situations where a type of expense can be conducive to both personal use and business use, right? So the IRS kind of carves out for some rules for when you incur these. How much do you get the deduction for? So we have M&E, meals and entertainment. We have travel and transportation, and then we have mixed use property, right? M&E, meals and entertainment. They always say it like that. M&E, M&E. You got to bifurcate the M and the E, right? So meals are separate from entertainment. They're not one thing. They're two different things. That's the first thing. Pull those letters apart. When we're talking about entertainment, right, this is generally not going to be deductible, right? So what would be an example here of entertainment? Hey, we're a business, a CPA firm. We take one of our clients to the football game, right? An NFL football game, we pay for his tickets. We're entertaining. We're taking this guy out to a show, a movie. We got box seats, right? The general rule is that's not going to be deductible for a business, entertainment. There are exceptions if you have like a company picnic or something, right? But the general rule is no deduction for entertainment expenses for a business. Likewise, meals, when we talk about meals, these are 50% deductible. And the idea for why is it 50%? Well, sometimes when you get a meal, when you take a client out or something like that, you're talking personal, you're talking business, right? But to qualify and get the 50% deduction for meals, it has to be ordinary and necessary. The meal, the amount has to be reasonable, right? Like, is caviar reasonable in this situation? Maybe not, but is a steak, right, or going to a nice restaurant? Yeah, sure, but we're not going to the Ritz, right? So the next one here is the taxpayer must be present when the meal is furnished. The meal is provided to a current or potential client. So what this means is it's not meals like you're going out by yourself and eating by yourself. It's you're taking a client out in this case. And if the meal is during an entertainment event, right, the meal must be purchased separately from the entertainment and on its own invoice, right? So if you look at that example 9.7, they kind of show some variations of basically saying, oh, hey, we took a client, we got box seats and we took them out to dinner, right? Well, the box seats are entertainment, you get nothing for. The dinner, you get 50%, okay? All right, next one here, travel and transportation. So as we have here, under certain conditions, self-employed taxpayers, so think one-man show who runs their own business, may deduct the cost of travel and transportation. Okay, so what's the framework to set up here? So the general rule is commuting to your principal place of business is not deductible, right? Say that you are a painter, right? You have a little shop where your customers come in, right? And you deal with them. Every day you drive to and from, work, commuting, the principal place of business, no deduction for that, okay? However, right, once you start using your vehicle in a business capacity, maybe we're going from our sort of like home base, our principal place of business, to a customer, then sort of the mileage and the car expense comes into play, right? When we use that vehicle in a business capacity, they really give you sort of two ways that you can do it, right? They let you deduct the actual cost plus like a stipend for depreciation or a standard mileage rate. So it's basically like, do you want to, for these times you're driving it in a business use capacity, maybe going to clients and things like that, do you want to actually track all the costs, or do you just want to use some flat rate like 50 or 60 cents per mile we're going to give you as a deduction? So you can see that there in 9.8. How does this change, however, right? So we talked about on a day-to-day basis, you're going into work, you're coming home, the commute doesn't count, but you go to clients, it does count. How does this work when you have bigger travel than this, right? So we're away from home overnight when traveling, right? It wouldn't be reasonable to expect us to come home. So the thing you have to distinguish here is this, when we take this kind of trip, is it purely business or does it have a mixed use to it, right? If it's purely business, right, so if the above conditions are met, then the cost of travel, right, so the airfare or whatever, like your train ticket, right, whatever the transportation is, you get that, you get meals, lodging, and incidental, right? So if it's pure business, right, and that's basically saying the entire trip, every single day you're there, you're working, you're doing this, you're doing that. If, however, it's mixed, the travel, then you need to look and say, what is the primary purpose of this trip? If the fundamental reason you're traveling, right, so we'll look at an example here, but say it's something like, hey, I'm going to California for a business conference, right? I'm going there to kind of improve my skills, things like that. And the fundamental reason I'm going is a business, right? And then, oh, by the way, when I'm there, I'm going to go to Disneyland or something just on my last day, right? Just to kill some time, right? Well, the primary purpose there is business. You do get the airfare. And then to the extent during that trip, right, you're going to look at the days that were the business days, you get the meals, the lodging, the incidentals, so on and so forth. If, however, it's personal, right, say that you're like, look, I really want to go to Disneyland in California, and then when you're out there, you just happen to see a conference or something, or you work, one of the days, you just take a day off because you got to do some work for your business, right? Well, in that case, transportation is not deductible, right? You do not get the airfare. However, on that one day, and to the extent you have business days, you get, those other expenses, Okay, so let's look here at 9.9. So the first one, right, they're telling us here, if we look at it, looks like we had, in this case, a $300 registration fee for a 3-day course in landscaping. So we have a self-employed taxpayer. He's traveling out of state overnight. It wouldn't be reasonable for him to return. It looks like some of the trip he was working, and then on day 5 he went sightseeing. Right, so they're then telling us some information here. They spent, this amount per meals per day. They want to know how much can this taxpayer deduct as a business expense, right? So really what's going on is we had, it looks like he was gone 5 days. Well, actually, no, it's the travel event. Okay, yeah, 5 days. Looks like one of them he was traveling, 3 were for business, and then the 5th day was personal. Right, he was doing that sightseeing. How does this work? Right, well, we have mixed use because it's business and personal. The primary purpose here is going to be business, right? So what that means is you get the airfare. The other stuff, right, to the extent you have the 3 days of business, right, you get the expenses for the lodging, the meals, the rental. Do be aware with the meals, right? People screw this up a lot of times. They forget the 50% for the meals. But that's the idea. You would take the air, the lodging, the meals, the rental, add them together, $1,435. This one, primary purpose is business, right? Mixed use, primary purpose is business. This one down here, the primary purpose is personal, right? So what's going on here is, looks like it was a 10-day trip. 3 are business and 7 are sightseeing, right? So the primary thing here is personal, which means you don't get the airfare. And to the extent, right, during that business use, you get the deductions for the others, right? So you can look at that there. Don't worry about the international travel, but I would say, this stuff's interesting. I would take a look at it. The next one here is that certain types of property, does have mixed use. So automobiles, computers, cell phones, right? You got to maintain records for this. The idea is you only get a deduction to the extent of business use, right? So say you have a car, right? And say the expense for it is 10 grand a year, and you're only using that to drive an Uber 20% of the time you drive the car, right? Well, you're only going to get 20% of that deduction. Say you have a cell phone, right, that you use in your business, your self-employed business. 40 or 50% of the time you use it personal, the other remaining time you use it in business, right? Well, the business percentage is the amount you get as the deduction. You don't get the entire deduction. So they kind of make you prorate that there. Now, do be aware, right, that in TCJA, right, so we're talking about limitations on deductions, they capped the amount of business interest expense, right? So we're talking about expenses. One type of expense is interest expense. It used to be once upon a time you could deduct all of your interest expense. Now there's a limitation, right, on it. So it's going to be 30% of your adjusted taxable income. It's kind of like EBITDA, right? Your earnings before interest, taxes, things like that. And the idea with this is, right, the interest expense limitation, right? So the interest limitation, namely the fact that we're capped to 30% of our EBITDA, that only applies to large taxpayers, right? Remember we said that 29 million test, right? If you're above it over 3 years, you're a large taxpayer. You have these special rules. One of the rules is that you're subject to business interest expense, like a limitation. If you're a small guy, right, you can continue to deduct all of it, but big guys, right, large taxpayers, we're going to cap you. So you can look at 9/11 there, right, that example for 30% of ATI, how that might work out. A couple other things here. Losses on disposition of business property. So, hey, you sell something at a loss, right, in a business, right? Maybe you have a machine in the business. You sell it. Your amount realized is $100. Your carrying value on it is $150, an adjusted basis, right? You're at a loss there of $50. When you have losses on the sale of fixed assets, you can use those to offset your income in a business, right? It's just like an expense there. Continuing here, business casualty losses. So again, this is in a business, right? It's not an individual casualty loss, right? It's not like your personal home gets destroyed. It's more like, hey, we have a business and the building gets destroyed, or we have a business in the car and the business gets destroyed, right? How does this work, right? Well, you have to see, right? First off, a casualty loss is when property in the business is stolen, damaged, or destroyed. And you have to say, is this thing fully destroyed, right? Or stolen, right? Like this, there's no coming back from this, right? It's like crumpled up into a pop can or it's burnt to a crisp, right? That gives us one treatment. Or is it damaged but not fully destroyed, right? So maybe our core got hit with in a hailstorm, it's damaged, but we can still fix it and live with it. Well, the treatment here differs, right? If it's fully destroyed, you're going to calculate your loss by any insurance proceeds for the amount realized, right? So in other words, you'll back out your basis, but whatever the insurance company gives you, right, that's going to be your amount realized there. If it's damaged but not fully destroyed, the amount of loss is going to be what you get from the insurance proceeds minus the lesser of the adjusted basis or the decline in value. Okay, so let's look at 913 to give that some numbers. So it's going to be, looks like we have business equipment. It was $5,000. We paid that in this case. It looks like before placing it in service, it's damaged in a fire. Okay, so it's damaged in this case. It looks like after the fire, it went down. It's now worth $1,500. And we get $1,000 in insurance proceeds. They want to know what is the loss deduction. So it's damaged but not destroyed. We're going to do the insurance proceeds is our amount realized, $1,000, minus the lesser of the decline in value, the $1,500, or our carrying value, 5. Right. So the lesser of these is $1,500. There we go. Our casualty loss is $500. Right? If we change the facts and it's completely destroyed, right, you'll use the 1,000 amount realized minus the adjusted basis, right? We'll have a $4,000 loss. All right, so with that, I kind of want to end it here because we're getting to the half-hour mark and I don't like these videos being much longer than this. So we will pick it up here in the next lecture and cover the last 20 slides or so.